Gold remains the one asset that turns risk into liquidity while politics and prices wobble. Right now, a fragile macro mix is reshaping demand for bullions, inflation headlines fade, and recession fears reemerge. Central banks continue to diversify reserves, while fiscal stress and currency volatility push investors toward a hedge with a long memory. In currency terms, gold prices have traded in a wide band, reflecting mixed signals from policymakers and traders alike. For households and institutions alike, gold is both a portfolio ballast and a speculative bet on geopolitics, energy shocks, and the pacing of monetary normalization that could shift markets overnight again. At its core, gold is a priced bet on uncertainty. When risk rises or currency values wobble, buyers flood into bullion as a portable store of value. When real yields rise or stocks rally, the metal often takes a breather. The current moment blends inflation remainders with a softer growth backdrop, keeping gold in a narrow corridor but prone to sudden moves on unexpected headlines. Traders watch the dollar, bond yields, central bank policy statements, and progress toward climate and energy plans. Exchange-traded funds flow in and out, amplifying moves beyond traditional futures markets. Developers and retirees alike second-guess their seasons. Gold has served civilizations as money, ornament, and reserve asset for thousands of years, surviving inflations, wars, and regime change. In the modern era, the dollar system created a monetary anchor, while central banks built sizable gold holdings during crises. The Bretton Woods era ended, yet gold retained its role as a hedge when financial satisfaction disappears and confidence falters. The metal's price reflects risk appetite more than industrial demand, since jewelry and electronics only account for a fraction of annual demand. Past spikes in 2008 and 2020 show how liquidity injections and fear can push bullion to record highs. Today, the market sits between fear and opportunity. Gold prices hover near multi-month highs as traders weigh geopolitical risk, inflation persistence, and central bank caution. ETF inflows have spiked during recent storms, then cooled as momentum cooled, signaling a tug between long-term hedging and short-term liquidity. In precious metal equities, explorers and miners rally when bullion rises, while producers face higher costs and currency headwinds when the dollar strengthens. Physical demand from emerging markets remains solid but not uniform, and consumer jewelry demand wobbles with consumer confidence. Overall, gold still trades like insurance, priced to discourage complacency today. Industries most exposed include mining, wealth management, and consumer retailers sensitive to inflation. Gold miners benefit from price rallies but face project risk, capex cycles, and rising energy costs. Banks and hedge funds reassess risk premia as bullion asserts its role as counterbalance to risk assets. Central banks continue to accumulate, shifting reserves away from other assets and altering yield curves globally. Microcaps and junior explorers become attractive for speculators. Established producers focus on cost control and project timing. Retail investors increasingly use gold as a protection layer in portfolio construction alongside stocks, bonds, and real estate and commodities exposure. Geopolitics and macro forces cast a long shadow over gold. Escalating conflicts, sanctions, or trade tensions can quickly lift safe haven buying as investors seek certainty. On the macro side, rising inflation, slowing growth, and shifting currency dynamics influence real yields and opportunity costs. The dollar strengthened after missing inflation targets, while emerging market demand grows in regions embracing foreign exchange diversification. Central banks across Asia, Europe, and the Americas balance reserve moves with domestic policy, sometimes leaning toward gold as a stabilizer. Market structure changes, such as tighter commodity funding or shifts in futures liquidity, amplify price responses significantly. Smart money whispers through fund flows and balance sheet moves. Hedge funds tilt toward longer gold exposures when dollar weakness appears likely, while cyclicals and growth stocks can derail the rally if rates surprise higher. Asset managers diversify with gold-related instruments, including small-cap bullion miners and streaming and royalty companies that monetize precious metal streams. Sovereign wealth funds quietly add to reserves in measured increments, signaling confidence in gold as a macro hedge. Retail investors increasingly use certificates of deposit and exchange-traded products to access leverage within risk ceilings, chasing yield while protecting portfolios against volatility. Today, every investment carries risk, and gold is no exception. A sharper global growth rebound, faster rate hikes, or an appreciating appetite for risk could deflate safe haven demand, sending prices lower. Physical supply constraints aside, energy costs and mining capex could squeeze producers and renew market skepticism about long-term supply. A stronger dollar, rising real yields, or a breakdown in geopolitical tensions might reduce demand for hedges and push markets toward risk on assets. ETFs and futures funding could unwind rapidly during stress events, triggering price gaps that catch unhedged traders off guard, creating opportunity only for disciplined strategists. Retail investors should plan a disciplined exposure to gold rather than chase quick moves. Start with a defined allocation, perhaps 5 to 10% of a diversified portfolio, then rebalance quarterly. Consider cost-efficient vehicles such as physical gold-backed ETFs or coins for liquidity, complemented by exposure to mining equities only if you understand underperforming times. Use stop-loss concepts and position sizing to manage volatility and avoid over-leverage. Monitor macro indicators like real yields, the dollar index, and central bank policy changes for clues on direction. Practice patience, then deploy capital when risks align with your thesis. Looking ahead, gold seems poised to remain the quarterly heartbeat of risk assets, moving with policy surprises and geopolitical headlines. A balanced portfolio approach will watch central bank messages, inflation prints, and currency trends to gauge whether bullion acts as shield or satellite. If inflation cools and rate paths flatten, gold could consolidate. If tensions flare or liquidity tightens, prices may rally again toward resistance. The core takeaway is preparation through informed diversification and a steady risk framework. Until then, stay curious and stay diversified. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.